So the topic of this video is actually quite interesting. This was a conversation that I was sort of going back and forth with a friend, and we were just arguing both sides, right? He's a very mechanical trader. He likes to follow sort of the set rules set and wait for this, wait for that. He's a very sort of like data crunchy type individual, okay? And then on the other side of that, you have more of a discretionary type where you rely more on experience and market intuition. And we were basically just battling, well, not battling, but we were just sort of discussing back and forth what was the sort of best way to really go about things, what are the advantages of either or. And yeah, you'll just see throughout this video my sort of conclusion on that. And then at the end, you'll actually see what I'd say I am on this sort of spectrum between mechanical and discretionary, and actually how I go about sorting my trade model accordingly in response to whether it has mechanical characteristics or discretionary characteristics. So 4 points here, the pros and cons of both mechanical and discretionary trading. Then I'm going to talk about the reality, and then, like I said, how I actually incorporate this into my personal trading. So, pros and cons of mechanical trading. So what is mechanical trading? Like I said, it's basically when you have a set rule-based system and you actually aim to trade like an algorithm. Okay, so you're basically trying to eliminate as much as emotion as possible. You're trying to basically have all the decisions that you wanted to take during the trade already made for you. Okay, so it gets to the point where all you need to wait for is like, let's just say your model was, and I know this is ridiculous, but let's just say your model was, I go on the 1 minute, I wait for a 1 minute swing high to get swept, then I wait for a 1 minute boss, and then I wait for a 1 minute FEG and I enter. Obviously that would be a bit of a crazy strategy, but just as an example, right? It's very rule based, it's very rule set. There isn't much leeway in that. Like if I gave that to you as a model, it's fairly easy to execute on, if that makes sense, right? Is it going to be profitable? That's another question, but it's just an example, right? And with mechanical trading, you'll have very like set time frames, you'll have very set parameters, all that sort of stuff, right? This is basically the idea though that you get sold as when you first go into trading, because that's how, at least it was sold to me. It's the idea that, cool, you're going to draw this trend line on the chart and you're going to be able to wait for this trend line break and then execute and sell, right? It's a very like mechanical type thing. It doesn't really explain the intricacies of trading, maybe the emotional side of trading, or the more complex side of things. That's how it's sold to everyone, because it's probably the most easiest and simplistic way to actually trade. So we've got the pros on the left. So first of all, it's easy to execute on, right? It's very simple. It's easy to build. Okay, why is it easy to build? Well, it's just going to be a couple set of criteria that need to be made. So it's easy to build as a plan. It's easy to duplicate. So what I mean by that is it's easy to pass that knowledge on to someone else and say, look, this is my strategy. Here are the criteria, execute on this. Now, here we get onto a bit more of a questionable one. It does, so I've written here very little stress on psychology. Now, that is true in theory. It should be, okay, but you'll notice it doesn't always hold 100% true. But in theory, if you had a really simplistic model with very simple criteria, to an experienced trader, it will have little stress on his psychology, 100%. But when given to a beginner, it's not necessarily the truth. Not much thinking involved. That's just because, like I said, your pre-set defined criteria is already laid out for you. So it should be quite simple in that sense, just to execute on the model. Again, it doesn't always act like that in practice. And then finally, it's easy to edit the strategy and sort of like data crunch. So let's say, for example, your model was that M1 sweep, M1 boss, and M1 FEG. Okay, you might notice that you would have better luck looking for like an M5 FEG, for example. And then what you can do is test your data against the first strategy, number one, with the M1, M1, M1. And then you could test your strategy against, or test the numbers against the second set of data, so M1, M1, M5, right? And then from that, you can go and see, okay, cool, which time frame do I have the most success with? Okay, cool, I'm going to implement that strategy, right? With a more discretionary model, you can't really do that, okay, because it's a bit more rely on intuition, all these sorts of things. So just from a purely like strategy editing standpoint, it's actually quite effective. So now what's the cons with this? Well, as we all know, the market is dynamic. It doesn't really stick to the same conditions all the time. Okay, so if you have a very mechanical model, you end up boxing yourself in. Okay, you don't really, again, this is just my opinion, but when your model is so strict, you may have very varying results, right? Where, and of course, not every month is a profitable month, not every month is like a high flying month, but it makes sense to me that if my model was so rigid, that potentially I'd have months where I'd be performing really well, but then other months I potentially would be performing really badly. Okay, and again, that's just due to the market being fairly dynamic. Okay, the other thing is you'll miss a lot of trades due to a very rigid entry model. So let's say, for example, your entry model was you only waited for an FEG on the 15-minute, which again, look, a lot of profitable traders will do, and there's nothing wrong with that. But when you have a very strict sort of like one PDRA, one time frame type entry, you're going to end up missing a lot of winning trades, right? For example, you may wait, let's say, a week and a half for like beautiful conditions, and then you haven't been able to capitalize on that just because you have sort of this really rigid entry model. In my opinion, it just doesn't make sense, because the entry model is just to facilitate your entry. It's not really like sort of the be all end all of the strategy. You know what I mean? Like I always say to like my students, the entry is should be the easiest part of the trade. That's just your entry into the market. It isn't the framework or the building blocks behind why your strategy works, if that makes sense. Now, a big thing, or I guess like a pit hole in, or pitfall in mechanical trading, is that people tend to arrive at different results despite them executing on the same model, right? And that's due to us not being robots, okay? So what do I mean by that? Well, if I gave you my model, or sorry, let's say I gave you the really easy 1 minute model, right? The M1 sweep, M1 boss, M1 FEG model, okay? And I gave it to your friend as well. It's actually very likely you two aren't going to end up taking the same trades. Now, that actually removes, or you could say, sort of invalidates the whole idea of mechanical trading in itself, because the whole point of, or the advantages of mechanical trading is that you're supposed to be able to take the same trades, right? Now, they will be similar. I'm not saying they won't be similar, but they're not going to be identical. And so that's when you got to ask yourself, well, are you more interested in sort of that algorithmic sort of like quant trading realm, right? Where computers sort of trade for you. You have to really balance that and think, okay, cool, am I a better facilitator of this model versus like a computer, for example? Okay, so moving on, even though it's designed to take out the emotions, as a beginner, you will still face psychological issues. The market is always going to be filled with emotions, especially for a newbie type trader. So even though it is mechanical, you will still have to overcome that hurdle. Now, don't get me wrong, as opposed to discretionary trading, when you do get to that more advanced level, having that mechanical set type rule set for certain parts and elements of your trading is beautiful, because it just allows you to fix issues that you may have in terms of like thinking too much when you're going to execute a trade, or sort of just having so many issues, problems, decisions to be made, right? It sort of just boxes them in, gives yourself those sort of set rules to say, okay, cool, I've built all the framework up, now I just want to be able to enter, or sorry, now I just want to be able to like manage the trade under a set rule set, like i.e. TPing at 50 pips or closing the trade at 3 p.m, etc, etc. Okay, and then the other con, which is a bit questionable, but your experience as a trader doesn't actually help you. And the reason that is because if you're sticking to rule set so religiously, then your sort of market intuition, market IQ isn't really going to bleed into your performance, right? Now, you've got to remember, when I'm talking about mechanical here, in this sort of set slide, I'm making the argument that you are 100% mechanical and you're not discretionary whatsoever. So that's why you'll see these points are extreme, but that's because I'm looking at it from that extreme point. So moving on, let's have a look at discretionary trading. So what is discretionary trading? Well, it's the idea that you're trading based on a more intuition / market experience type element. Okay, now, of course, I'm going to view this as a 100% intuition, market experience based thing, but in practice, you're obviously not going into the chart and just executing on what you see, although you'd be surprised how many people actually do that. So let's have a look at the pros. Your ability to be adaptable is really, really good, because if you have enough experience in the market, then obviously you'll be able to really sort of get under the hood of the market and have a feel for maybe what's going on, what sort of conditions you're in. Are these conditions that you thrive in? Are these conditions that you don't thrive in? And you'll actually be able to keep up with the dynamic market, because, like I said, you're not sort of boxed in with these rules. You don't have to follow this sort of very meticulous religious type rule set. And over time, again, this in theory, over time, as your experience grows, so should sort of like your trading performance and ability. But we understand and we know that that's not really the case. But from a theory aspect, that does make sense. And having like a variable rule set means that you can flourish in different market conditions. So when you are, let's say, discretionary, you may have systems or sort of procedures for multiple different conditions, meaning you're able to actually perform well in an array of different market conditions. Now, let's have a look at the cons, right? So this is the biggest issue. What most people will end up doing is overestimating their actual capability in the market, okay? If you do know a discretionary trader, you'll know that, and let's say they're not that advanced or they're sort of in that intermediary stage, they will 100% of the time think that they can do more than they actually can. They may have a bit of a fair and good run, like a win streak, for example, but it's often short-lived, right? Another thing is that the information overload is often going to lead to analysis paralysis, and this is because it's a very stressful environment in the markets, right? Ideally, you want to come into the market with a lot of the decisions actually already made for you, right? And when you have so many decisions to make in like the heat of the moment, for example, you're obviously just going to become sort of like more susceptible to fear, and it's going to be harder to make the right decisions. So therefore, like I said, right, there's a lot of factors to actually consider in this, and that's a big issue, because to make good decisions, right, or they normally say, right, you can only make, let's say, 1 to 2 good decisions a day, right, and that will be based on like executing on a trade. Now, if you have so many things to consider before taking that trade, your performance is obviously going to get hindered in some sort of way. Okay, and on a long period, it's actually very hard to track your system progress and results. And the reason that is because, or think about it like this, if you're executing on a model and you have, like, let's say the set rule set, like the M1, M1, M1 thing, then your data is going to be very accurate to that model, in the sense that you're actually following the model and executing on trade, and therefore that data is going to be reliable and accurate to that system. Whereas when you're just sort of taking trades willy-nilly and just executing on what you see, you don't actually build up a very good track set of results, because, for example, on one system or one trade, you might be entering off of FEGs and I don't know, breakers, and then on another one you might be entering off a rejection block, and then you might the next trade is going to enter off this and that and blah blah blah. And from that perspective, you don't actually make any progress, because how would you know out of all these different PDRAs which one's actually giving you the most profit? Okay, because again, you're going to be looking at it from a completely discretionary standpoint. That's where the nice sort of data crunching mechanical side comes in, where you could go ahead and actually evaluate which PDRA yields you the best result. But from a discretionary trader's standpoint, they're just going to look at it as like, okay, cool, I know what to do. I know when the market's, or I feel the market's going to move this type of way, and then they execute on that sort of idea. Okay. And then overall as well, they're going to obviously be more susceptible to fear, because there's so many decisions to be made, which in turn is going to affect performance. It's going to affect the average results of you as a trader as well. So realistically, month on month, your results are going to be very, very skewed with this as well, because you're not repeating a set process. So the reality of this, and you probably realize where I'm going with this, is that everybody, okay, is somewhere in between this, right? No one is 100% mechanical and no one is 100% discretionary. You're going to end up being somewhere along this line, right? Others may be more towards the mechanical side, and you may be really close to the discretionary side, right? Now, I believe personally that you need to be in balance, right? There needs to be a set part of your model where you are mechanical, but there's elements that are going to be discretionary, because that's really what sets us apart as traders, right? If you really think about performance as a trader, and the fact that if I was just to translate all my knowledge onto, let's say you, for example, you wouldn't know how to execute the model, but you also wouldn't have all my experience that actually backs up the idea that I know what I'm doing. So for the person who's coming into the market, we all know that experience does pay off, because otherwise you could come into the market tomorrow, I could teach you everything I know and you should be profitable, right? But you know as much as I know that it doesn't work like that. Okay, so the idea of others being successful in this market based on a time period and time spectrum actually validates this idea for us. Okay, so when you really get down to the nitty gritty of it, what I found that my solution was to split my trading model up into elements and then see if I was better served taking a mechanical approach over a discretionary approach, or vice versa. Okay, so I'm actually going to do this with you guys now, and hopefully you can do this with your own trading model and see how you get on with it. So how do I incorporate this into my trading? The answer is simple. I algorithmize parts of my process and leave indiscretion where it's needed. Okay, again, if you really think about this, we want a sort of fair balance between the two. We want enough mechanicalness in the model so that we can actually extract some data and be able to process the trades as a whole, and be able to analyze data and get better. But at the same time, we don't want to take out our ability to read the market, our experience, our tape reading, our just sort of like that market IQ and intuition that you build up. You don't want to hinder that or not be able to flourish with that part of yourself. So that's why, again, we need that balance, right? So this is like a little flow chart that I made. It's very basic, and it's I would say it is the bare bones of my like strategy / model / process, but just written out in like really simple terms. So starting off, has the market taken liquidity and has an obvious draw on liquidity? Can I forecast the expansion of X candle? And X for me is defined in a mechanical way. I have set timeframes that I'll look for in terms of candle expansion. Does this expansion coincide with one of my daily cycles? Refer to flow map that I built for students. And entry technique ? Right? So let's just say these are like the four main pillars, or the thought process that I go through in order to take a trade. Now you should actually go ahead and do this for yourself, as it will help you really sort of construct the idea behind what you're actually looking for when it comes to trading inside the market. So I split it up into 3 points, right? We have finding bias, which is the first 2 points. We have trade framework, which is the middle. and we have entry on the right. So let's have a look. So first we have basically finding bias, right? And now let's outline the discretionary part and the mechanical part. Now, I'll start on mechanical. The way people find bias using a mechanical edge, right? And you might have seen these sort of things online. It's where, for example, people will say, I'm waiting for a previous day's low to get swept, and you wait for like a specific like candle formation to occur, right? I'll draw one up for you. So like, for example, let's say the market comes beneath this low. They'll want it to look like this on like the intraday, and then on the lower time frame it might look something, I don't know, like this, where it's some sort of like engulfing candle above a high, and then after they get that, then they anticipate the next candle to be bullish, for example. That would be a purely mechanical standpoint on how to actually approach finding bias. Okay, now the discretionary part is, I'd say, a million times better like this. So basically I do discretionary in this sense, and the discretionary side would be essentially just built on your market experience, right? So we understand that the market has two functions, is to either take FEG and sweep liquidity. We understand buy and sell programs. We understand how the market moves from PD array to PD array. And so from that, I feel confident enough to be able to form my bias, right? If I understand the underpinnings of the market, and I understand, or I've seen enough charts or had enough chart time to be able to construe a well-formed bias, then I'm obviously going to use discretionary, as trading mechanical in this sense is just going to limit me on so many different trades, right? Now you can only really trade discretionary until you've actually proven to yourself you actually can find bias accurately on a large and consistent basis. So for example, there's another factor you have to take in. On the mechanical approach, that's sort of like a bootstrap, here you go, trade tomorrow type thing, where this specific candle model is very easy to find and someone can give it to you, and then there you go, bias is fixed for you. Okay, whereas on the left hand side, discretionary is going to take a lot longer to do. However, you're going to have a lot more trade setups on this side, and also, in my opinion, you're going to have a lot better win-loss ratio doing this, because we understand that the market, like I said, is very dynamic. It's not pattern based. You might have a few good runs with this, using this sort of weird candle formation thing, but we know as a discretionary trader that the market is dynamic, and I simply couldn't just wait for that model and it's going to produce a result for me every time. Now, don't get me wrong, right? And this is where the intricacies and sort of the balance comes in, is that mechanical model of that thing that I drew out, right, is referred to as a swing point. Now, if you know the right conditions that you want to see that swing point form, i.e. in a higher time frame PD array, we're in a buy program, we just come from an FEG, etc, 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 then you can actually take that mechanical model and integrate it into your discretionary, and therefore you become a bit more balanced there. Okay, if that makes sense. And that's, again, essentially what I have. But in or on the spectrum of discretionary and mechanical, I'm a lot more discretionary when it comes to finding the bias. Now, trade framework. So a lot of you guys might not have this. This might not be as obvious, or you might not really understand what this is. But basically, once I've defined the bias, I have sort of these set models or profiles that I want to see, or how I want to see the expansion unfold. Okay, so for example, if I'm trading during London, I want to see like the lows made at specific times. I want to see price run at specific times. I want to see certain highs made at specific times. I want to see certain retracements into FEG, all that type of stuff I've characterized in what I call my daily cycles. And that's essentially the framework of my trading. And the reason I did that is because I identified those cycles as high probability expansions. So if let's say the bias is good, the bias is set, then if the daily candle is following one of these cycles that I've outlined, then I know basically the trade is extremely high probable and likely to continue on my side. So you could probably tell already which one am I favoring in terms of trade framework. well, it's going to be mechanical. Okay, and the reason I like doing this is once I've done the heavy lifting with the bias, then I just like to follow a nice easy framework. Now, don't get me wrong, the frameworks took a very, very, very long time to come up with. And at a point, I would have been sort of discretionary trading the daily expansion. But now I have very, very set profiles that I like to see and I like to have. That are basically a must for me to take a trade. Now, you could make the argument and say, well, are you limiting your trade count because, again, you're waiting for like very set specific highs and lows? Well, first of all, I have quite a few daily cycles. There's in total, I think there's like 8, so there's quite a lot. You don't actually have to use all of them. You can use some of them, but as you probably would have realized, the more cycles you have, the more trade potential you have pretty much. So it's not really like I'm that limited. Now, again, you could still argue and make the idea that, the market's quite dynamic. Why are you not discretionary? Well, those cycles, if you, again, had access to them and you saw them, you'll realize they're so accurate in terms of price delivery. Like, even I'm surprised, like myself, that I've been able to characterize most expansions in price down to 8 different cycles. But again, it was just something that sort of came up and they work really, really well. Now, again, of course, there are some moves that I end up missing because I'm waiting for the very set sort of rule set of the profiles. But also, there are so many losses I will miss out on due to the fact of waiting for very set sort of profiles to unfold. Okay, so that's how I really weigh out this from a discretionary and a mechanical standpoint, and that's why I'm very mechanically favored for the framework. So for the entry, now, just straight off the bat, my entry technique is fairly discretionary, okay, but it does have elements of mechanicalness to it. But the way I do the entry technique is I will limit my time frames, so there'll be set time frames that I want to see an entry on, and there'll be set protocols as to how I could dip down to a really smaller time frame if I wanted to. So that's the mechanical side of it. But in terms of like what PD array do I use, what do I wait for, blah, 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 that is a bit more on the discretionary side. And like I said earlier in the PowerPoint, the reason I actually do that is so if I've already got my bias down and I've got the framework down, then the entry is just facilitating my entry into the move, if that makes sense. Like, it doesn't really have any other use case. Now, I know some other people, their entry will be actually a confirmation to say, okay, look, this trade's actually moving. Like, I do use like displacement and stuff, but for example, their entry model might actually be like a really strong determining factor in whether the trade's actually going to go or not. Whereas my entry technique is just me sort of trying to catch the wave or the move, because I already know if it's following the daily cycle and the bias is there, it's very likely the trade's going to unfold anyway. So the entry, I'm literally just trying to get behind the move to ride it out, and that's why I keep my entry quite discretionary. Okay, like I said, I do have set models, but if I notice the trade running in a certain way, I'm not just going to sort of freeze and wait for an FEG if we're like displacing like crazy, because I'm sort of versed enough in the entry world to know where and what not to do. But with the entry, if you're more of a beginner, I would actually push you towards the mechanical side of things first. Once you can get a good mechanical entry under your belt, then I'd say you can move to discretionary. But as a sort of newbie and beginner, I would actually keep the entry fairly simple, because I actually do think the entry is the hardest part in terms of psychology, because that's when you're actually entering the trade. I did say before that the entry is the easiest, and what I mean by entry is easiest, I mean that out of all the steps you take, the entry is the most simplistic in the sense that you just need to enter. But from a psychological standpoint, it can often be the hardest point, because obviously that's the actual point where you're in contact with the market. That's the point where you're actually looking to engage. So that's where, again, the entry technique I like to keep fairly discretionary. the cons of that is that there's a little bit more psychological stress involved, but it allows me to actually get behind the trade. And to eliminate the psychological stress, like I said, I have the bias and the framework behind me. Okay, so that actually concludes everything I actually wanted to go over. If you actually want me to go ahead and coach you one-on-one and just go through that sort of process with you, or maybe just actually show you my own model/strategy so that you can apply it with yourself, then go ahead and click on the first link in the description. There's actually a really interesting discussion you should have, maybe with friends of yours, traders, friends of yours, or just yourself, on how you're actually characterizing your own model. Because for me, having these discussions really opened up and allowed me to actually really go in depth with my own trading model and evaluate which parts are mechanical, which parts are discretionary, and which parts actually should be maybe more mechanical and more discretionary, if that makes sense. So anyways, if you have anything to add, or if you actually want to ask me some questions on maybe how you should do this yourself, just go ahead and drop it in the comments and I'll reply if I can. Anyways, hope you guys enjoyed the video, and I'll see you in the next one.